a loss of 2.73 lakh crore INR in just 6 days. You heard that right. India's top IT companies, Infosys, TCS, HCL Tech and Tech Mahindra have seen their market values crumble in less than a week. But why is one of India's most trusted sectors suddenly in absolute free fall? Let us tell you. Since April 2nd, 2025, the Nifty IT index has nosedived to a 17-month low. It's fallen by over 26% in 2025 alone. The losses, jaw-dropping. As I told you, 2.73 lakh crore INR collectively. Individually, the situation is equally grave. Infosys down by 73,138 crore. TCS 1.34 lakh crore INR wiped out. HCL Tech 50,067 crore vanished. Tech Mahindra 16,305 crore INR gone. Together, these four giants have lost over 2.73 lakh crore INR in market capitalization. I mean, Gen Zs would say that the market is shook, and no, not at all in a good way. But this is not just about numbers. This is about fear triggered by something brewing thousands of miles away in Washington, D.C. The real, absolute jolt came when US President Donald Trump announced reciprocal tariffs on America's trading partners, reigniting fears of a global trade war. These tariffs are aimed at reducing the US trade deficit and boosting domestic manufacturing. But there is a catch. Indian IT companies heavily rely on the US for business. Between 49% to 62% of their total revenues come from American clients. So, when the US flexes its protectionist muscles, Indian IT feels the tremors. Why? Because the very foundation of Indian IT exports, outsourced services, contracts, and IT consulting gets directly impacted. With these tariffs escalating, the fear is that US companies will cut back on outsourcing, renegotiate deals, or delay digital transformation projects. So, in short, much less work for Indian IT and more volatility in revenue projections. And then comes the recession domino. It's not just the tariffs, it's what they signal. A slowdown in global trade, and with Morgan Stanley predicting US growth to drop to around 2% or less in 2025 and 2026, recession fears are back on the table. Investors are worried that an economic slowdown in the US will ripple all across the globe, and India's IT sector will be caught right in the middle of that very storm. When recession fears rise, corporate tech budgets get slashed, project pipelines get shrunk, and high-margin deals dry up. That's what the market is pricing in right now. Adding fuel to the fire, global brokerage firm Nomura has cut target prices across major IT firms, slashing Tech Mahindra by 14%, Infosys by 12%, HCL by 8%, and even TCS by 6%. They have maintained a buy rating on most companies, but the lowered expectations reflect one thing. The sector's growth is going to slow down and earnings may not meet earlier projections. So one thing is crystal clear. What we are seeing here, it's not just a knee-jerk reaction, it's a systematic correction. It's driven by macroeconomic uncertainty, trade tensions, and a recalibration of expectations. So can Indian IT bounce back? Probably. I mean, there are companies with strong fundamentals, cash reserves, and long-term contracts. But in the short term, investors should brace for volatility. So if you're an investor, I want to ask you, are you holding on to your IT stocks or planning to exit? Let's talk. Let's discuss in the comments. If you found this breakdown useful, hit that like button and subscribe for more AI insights, more tech world insights. Think AI, think AIM.